Understanding breadth, market breadth, and using market breadth to calibrate your trading in terms of risk and in terms of like identifying which time periods are good for trading and which time periods are not good for trading is going to pay you many more times. So here is the thing, right? This is a market monitor. It daily tracks the number of stocks which are having 4% plus breakout. It tracks number of stocks which are down 4% plus. This ratio, 5-day ratio, is a ratio of this 5 days of this divided by 5 days of down days. So you see 2.49. This 10-day ratio is similarly 10 days of this divided by. So as you can see, since last 4 days, there are two stocks which are making 4% breakout compared to breakdowns, or two times more stocks, and now it is 2.5 times more stocks are making. And if you see, this is a primary indicator. That means it tells you, because this is, it takes time for a stock to be up 25% in a quarter, so it confirms that there is a big money coming into the market. So when you see this is positive, is when you will see that breakouts will have very good momentum, or they will have very good follow through. And these are all secondary indicators. They give you some more understanding, like if you are say struggling in trading, and you are saying that there are no opportunities, like I see a lot of people saying, then the question is, there are almost 237 or 243 stocks which are up 25% in a month, or there are 39 or 42 stocks are at stage 1, stage 50 stocks up 50%. So what is it that is the problem with your trading, that you cannot find some of these opportunities, is the question which you should be asking then, right? Now if you look at this particular thing, what started happening is we had some selling in March, right? And there was a heavy amount of selling, 1500, 575, and then little bit like buying started coming, a little bit buying started coming. And then really from like an around last week of April is when you saw continuous buying coming in, as you had 300 days, 300 days, 400, 300, 600, 600, and then the market came and breakout started working. So breakouts have been working from almost like in May, June, they have been working. And especially in the last 10 days, they've really done very well because the primary indicator has turned bullish. So market breadth is an information which you derive based on actual buying and selling pressure in the market, right? When you look at this, it tells you exactly whether there is a buying or selling coming into the market currently. And the information is derived from the data which you're looking at daily. So as a result of this, this allows you to be objective about whether there is a bullish money coming in or bearish money coming in. A lot of time people are very bearish on the market based on their hypothesis, based on their views about political parties, based on their views about economy, or based on their need for, a lot of people have this thing where they wish that the economy will tank, or things are bubble, or things should go down, and this is problem, that is problem, like, or deficit is a problem, and that is why stock should go down. But what happens is, here you see the stocks are always going up, right? And it means like and this buying kept coming into this market, and as a result the market has improved. And you can see the same thing on indexes. If you look at the indexes, you can see that the buying has been coming in into the market, especially if you see things like the QQQ. The QQQ has been going up since April, and you will see that since April the number of days when you had a lot of buying, and especially in May end is when there is a lot of buying which came in. Similarly, if you look at SPY, same thing happened. And if you look at like something like TNA, which is small cap, only in the recent days it has started attracting buying. So understanding market breadth in detail is going to allow you to create tools which will allow you to see whether there is a lot of buying selling coming into the market. There are a number of other tools which you can create, like for short-term trading. Like I have a tool which is number of stocks which are up 20% plus in last 5 days. And if you look at this, this is at 37. That tells me that the market is not extremely overheated, because this is like this acts, these numbers acts like oscillator. If the market was extremely overheated, then you get around 100 plus numbers. Now it is not at that numbers, and when these numbers go down or they are below 15 is when you see buying coming into the market. So these kind of market breadth kind of things are being used for centuries by traders to create market timing methods. Some of the most well-known market timing tools in the market are based on market breadth. So understanding of market breadth will allow you to not only profit but to keep your profit by understanding when to get out of the market, when to be aggressive, and when to be cautious in the market.